This is one risk that many people that we work with are concerned about right now, and that's simply healthcare costs and the rise of long-term care costs. And obviously this is a big concern because, as we all know, we're all getting older, but we're not necessarily getting healthier, which means that the cost of care is going to rise. And right now we have 10,000 baby boomers turning 65 every day. And that's happened for the last 10 years, and it's going to happen for 10 more. And so we know that there's an influx into the system right now. And as we all know, when there's high demand, what happens to cost? Obviously, cost is going to go up. And so we're seeing long-term care be a very, very big risk for many people's retirement. And so today's episode, we're going to talk about how to plan for long-term care. We're going to talk about the many different options. We're going to talk about, is long-term care insurance a good option or not? We get that question a ton right now. And as you know, long-term care insurance can be quite expensive. So we're going to talk through the pros and cons of that and really just try to help you make a better, more educated, and informed decision when you look at how to plan for long-term care.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
We know that there's a 7 out of 10 chance that you're going to need long-term care at some point, and so we know that this can be very detrimental if we do not plan for it. And I've had some personal experience with this. I've had 3 out of my 4 grandparents have needed long-term care, and so it's really going to be, if you know someone who's needed long-term care, you know it's going to be very, not only detrimental financially, but also emotionally. So obviously, the emotional side is going to be extremely hard to deal with no matter what we do. But if we can make this financial side a little more comfortable, a little more at ease, then things are going to be very, very, very more so beneficial for you as we progress. The other thing we have to think about with long-term care is we have to understand the cost of long-term care. Now, based on a study done by Genworth, and you can go on their website, it's a cost of care study that they've done. They say that long-term care will cost about $100,000 if you need a nursing home per year on average. It's going to depend on where you live, but that's about the national average if you want a private room. Now, if you have someone come home and take care of you, then that's going to be about $50,000, $60,000 a year is what they estimate. But as you can tell, that's a very, very high cost. Now, the average amount of time that someone needs long-term care, it's not anything 10 plus years. It's usually a shorter amount of time. Typically, we tell people it's around 2 to 5 years. And obviously, based on gender, is going to depend on if you're going to need it for longer or shorter. Typically, males have a shorter time horizon there, and females have a longer time horizon there. So something to plan for, if you're male or female, is going to tell if you're going to need this more so or not, is what the stats show. So I'm going to talk you through 6 ways to plan for long-term care. So the first one I'm going to talk about is self-insuring. Now, when we think about self-insuring, we think about using our assets, our investments, the money that we saved all these years to pay for the care that we need. And now, this could be a very reasonable thing to do for many people if you've been a diligent saver. Now, if you don't have as much money, this may not be an option, right? Because you may be able to spend through that money quicker than what you have saved. So if that's the case, this may not be an option for everyone. But for those who have been a diligent saver, a lot of the clients we work with, we look to utilize a self-insurance way of doing that. And the way that we maximize that is making sure that our investments are structured in the right way. And so this is always typically a part of our plan. And then with the other 5 options I'm going to show you, typically we utilize 1 or 2 of those, but depending on what the client is looking for, as a way to supplement self-insuring, because we don't want to put too much risk on our investments. Because, for example, what if the market's down and we need money? Or the tax impact. What if no one has any money in Roth, everything's in tax deferred, and now we need to take a large sum out for a nursing home like we talked about? That's going to be a huge impact. So when we look at self-insuring, we want to make sure we're being tax smart with our investments, making sure we've got them positioned the right way, making sure we don't have our money tied up that we can't access if we do need that amount of money. So those are going to be all important things when it comes to structuring your investments. And so those are all things that we look at, but we do also want to look to, utilize something else just to make sure we have added coverage there for most people. Now, for some people, self-insuring is all they want to do, and it works well, and that can work for you. But I'll show you the other option just in case that's of interest to you. The second option, which may not be everyone's favorite, but is definitely an option, is having your kids or spouse or someone take care of you, and then you don't have to pay for the long-term care. Now, the pros of this is you don't have to pay anyone. The cons are, well, are they going to be able to deliver the amount of care that you need? Are they going to be licensed nurse? Are they going to be able to, to prick you with needles and do all the things that typically you'd have to have done at a skilled nursing facility? So those are the things that you want to evaluate. Also, remember, you're probably going to need help transferring at this moment. Is your spouse going to be able to transfer you at that time? Are your kids going to have to transfer you? Are you going to have someone bathe you and take you in and out of the shower? Those are all things that are very realistic to think about when we get to that point and evaluating if this is a good decision or not. Personally, I would not recommend this decision because I think it's burdensome for the spouse and the kids, not only mostly emotionally more than anything. But again, if you don't have the money saved, you don't have the ability to do the other options, this may be the only option you have. Or you can be eligible for Medicaid, which is another option that you can think about, and that's when you spend down your assets, which we'll talk about as another option here later on. Another option you could look at is life insurance. Now, some people don't necessarily think of life insurance as long-term care, and I would agree that that is the case. But with some life insurance policies, some permanent life insurance policies, you can accelerate the death benefit while you're living and use that for long-term care. Now, why this could be beneficial is because you're now leveraging your money and you're getting more benefit for what you're paying for. The other benefit of this is it's tax-free. It can be utilized for tax-free for long-term care, and so that could be useful as well for many people. And so if that's you, that could be an option where now you have a double-edged sword that you could either use it for long-term care, or if you pass away, now it goes to the kids, the grandkids, whoever, tax-free as well. And so that may be something you want to look into. And understand, if you have an older policy, it may not have this benefit rider or this attachment to it to allow you to do that. So that may require you to either replace the policy or look at a different policy if that's your goal. But also understand with life insurance that it's not for everyone. Obviously, you have to be insurable. You have to understand that it's going to come at a cost that you have to pay, and you have to see if that's going to be worthwhile for you in the long term. But for some of our clients with legacy goals who want to make sure they're saving money on taxes, then life insurance could be a way to help mitigate that, but also add another supplement to self-insuring for long-term care. Staying on that insurance track there, the next topic I want to talk about is long-term care insurance. As I mentioned at the beginning of this video, I'm not sure if long-term care insurance is necessarily the best option right now today. Now, that should not discourage you from going out and looking into it because it could be the right option for the right person. But I can tell you with a lot of the clients we work with, we just don't necessarily see the value in paying into that with, one, the opportunity of never using it. Like I said, I think that we'll use it, so that doesn't necessarily worry me as much. But I just don't know if there's enough leverage for what you pay and what you get. Maybe just investing that money in self-insuring could get you similar type of results over time with, not having any concern there with the insurance company played in. So just a consideration. I'm not saying it's bad. The other good news with long-term care insurance right now is there's many different options. So there could maybe be a hybrid option that would make more sense for you. So again, I'm not telling you not to look into it. I'm just telling you that right now with our clients, we don't really look to utilize that as much anymore because of these other options that we have. But also remember that most of our clients have been diligent savers, so we have more options. So depending on where you're at, could ultimately tell what you look to do there. Another option to think about is what's called Medicaid planning. So there's many different types of ways to think about Medicaid planning. Let's first just talk about Medicaid planning based on the fact that, hey, maybe I don't have that much assets. Well, in that case, after you spend down all your assets, you'll be eligible for Medicaid, and the government will come in and give you that nursing home that you need to make sure that you get the care that you need ongoing. So, worst case, you may not have any assets, but you're at least going to get the care provided to you ongoing. And so we see some people that maybe they don't have as many assets, they just do that, they spend it down, they go get the care. Now the downside is there's nothing left over to that beneficiary. If you're married, there's certain exclusions allowed that there's still something that can pass on to them, so they're not left with absolutely nothing, but they do have to spend down the majority of the assets, which may not be necessarily the right thing for most people. So one thing that we look to do for some people who are okay with the fact of Medicaid, having that Medicaid step in for planning, but don't want to see their assets go away, is something called a Medicaid Protection Trust. Now, this is something you're going to want to seek help with an estate planning attorney. So we have an attorney that meets with our clients here at our office that goes through these types of trusts with our clients to see if it makes sense for them, and if so, make sure it's getting implemented the right way. And so with this type of trust, basically the idea is very simple. You take your assets, you put it in the trust, and since it's now in that trust, it's technically outside of your estate, which means when the government goes to spend down your assets, they can't spend down these assets because it's out of your estate. And so because of that, you can be eligible for Medicaid even though you may have millions of dollars in this trust. And so it's a way around, and it's a loophole to make sure that we can do that. It's completely legal. We see a lot of people do it with success, but you want to make sure you're setting it up the right way. And when you move that money to that trust, if you set it up the right way, you can still have access to it, but you want to make sure that you do that so you don't just tie up your money and you can never touch it again. So again, our attorney does that with our clients here. But very useful opportunity here if you're worried about long-term care and you want to protect your assets and you want it to go to that next generation or to your spouse or whoever it may be. This is something that we would look to utilize with many people, and it's become more popular nowadays. There's just some things you need to be aware of. For example, the look back period. So depending on which state you're in, it could be 5 to 10 years, depending on where you're at, where you have to make sure you do this before you need long-term care or they can come back on it. But if you have enough time that you've done this, then you could be in the clear, and it could be a useful strategy for you to look into. Another strategy that I'll mention is something called a home equity line of credit, a HECM. There's all different types of concepts here to think about. Now, this is one that we don't typically use as like the first strategy, but it's something we want to have in the back of our mind, because understand, when you're retired, most of your money's in your house, and with house prices increasing so much, you've probably got your biggest asset in your house, or one of your biggest assets in your house, and you're just not going to plan to touch it. Well, we can always tap into that if we need to. Now, I'm not telling anyone to aggressively take all their money out of their home and go gamble it away. I'm saying to strategically use that asset there for a couple reasons. Maybe you can go touch that asset if maybe the market's down and you don't want to pull out money from the market when it's down. Maybe you can go tap into that house so you don't have to increase your tax rate when you're pulling out of your tax deferred. So you can use it as a strategic vehicle. Again, don't take everything out. Just take out enough to cover what your expenses are, then pay it back as soon as that opportunity presents itself in a more fruitful way. So almost use as a placeholder there that you can go touch and access if you need to. And so again, we're not counting on using that house to pay for all of our long-term care, but it could be a very good placeholder for the self-insuring strategies that we've talked about that many people just don't think about because they think their house is paid off, that there's nothing they can do. Well, no, you can actually utilize that. And that's why we also recommend a lot of our clients keep a home equity line of credit available on their house that they can tap into at any time. I'm not telling you to leave that open forever, but pay it off when the time is right could ultimately be a good idea. So with that being said, those are the strategies that we typically look at with our clients for long-term care. There's many other strategies out there as well, but those are some of the more popular ones that we're seeing right now. If you're looking for more guidance on long-term care or something you heard in this video you want to talk about further, feel free to reach out to our team. If you're watching this on YouTube, there's a link below in our description that you can actually pick a time to meet with our team here. If you're listening on a podcast, just go to our website and you'll have the same opportunity, peakretirementplanning.com. And if you enjoy this content, go ahead and like, subscribe, tell people about it. We just want to make sure that we can help people make more educated, informed decisions with their retirement so they can live that retirement that they dream of.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.